Jim Stening is with me in studio from FIG Securities. Jim, great to have you in, and a great topic to be able to chat to you about as well. Yeah. Just give us a bit of a background on what's happened to the yields on BP bonds since we had this spill in the Gulf of Mexico.
Okay, well, there's been a pretty dramatic spike. I mean, whilst we've had that big fall off in the equity price, we've had a massive spike, as you can see on the screen, in the credit default swap spreads in that particular issuer. So that's translating into far higher borrowing costs for that entity, and it's being perceived as a much higher risk by the market. And
we use the word distressed in these kinds of circumstances, which you were just telling me before. I mean, obviously we saw it through the GFC, but...
yeah, we've seen these sorts of spikes and moves in individual credits sort of ad nausea through the GFC. But interestingly, if you look at the price action from that chart, it's been very stable for a long time. So it has erupted, if you like.
What about the news overnight that BP's got this fund, this clean-up fund, also suspending the dividend? How did the bonds react overnight to that then?
Yeah, well, this is a really useful sort of, I suppose, practical example of the differences between equity investment and investment in debt. I suppose the suspension of dividends is not something that sits well with equity holders, and nor is asset sales, because it obviously has implications for growth. But that's a very good thing for debt holders, because what it means is there's more subordination in the company. Now, obviously, part of those funds will be leaving the company to go into this fund, but as a debt holder, that does present a bit of an opportunity, given where these yields have spiked to, particularly in the short-term debt.
Because it seems that there are people buying BP bonds at the moment, but it's those bankruptcy players and the distressed buyer players.
It is. I mean, I think interestingly, I read an article on Bloomberg that Bill Gross is buying short-dated BP paper, and I think you know, practically speaking, BP is a very profitable company, or has been, and it's got plenty of cash, and these payments into this account will be over a number of years. So in terms of their commitments, as far as debt goes in the short term, then they're more than likely to meet them.
Okay, so you don't see that there's a risk it will struggle to meet the obligations, and I mean...
Oh, there are obviously risks. I mean, I think, you know, the downgrade, 6-notch downgrade from Fitch is a reaction to those risks. I suppose, you know, you've got to overlay the fact that there's I suppose, an ethical dilemma when you're investing in BP, and an ongoing problem for them as a brand that needs to be factored in. That's very difficult to quantify, and something that will play out over time. But I do think that as far as short-term yields, particularly in excess of 10–11%, you know, that is quite an attractive proposition, as opposed to an equity investment.
Okay, so it's kind of problematic. There's potentially buying opportunities, but for retail investors, are there buying opportunities in something like this?
Look, there are.
Or do you leave it to those big guys?
Well, interestingly, I mean, some of the Euro bonds that BP have issued are available in smaller parcels. I think in terms of A dollars, they have a March 11 maturity. They also have a July 14 maturity, and